Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Tuesday, March 14th, 2023. It's 9:57 a.m. Eastern Time as I'm starting the video, and I wanted to get this one out early today. I wanted to let the market open, see how it traded within the first half hour or so, and really based on where we're at, I want to just get this one out to you guys, give you my thoughts. First and foremost, nothing has changed, nor will it change unless we start to solidly move away from this key level right here, which is the intersecting 200-day moving average that's capped pretty much most of the rallies since the bear market started. And then also, as if not more importantly, the primary bear market downtrend line, both of which were recently taken out. So we're up today on I don't know what you call it, benign CPI number, pretty much right at expectations. And but from a pure technical perspective, this is simply a failure back below those levels and a back test. So you can see we are right on the trend line right now, back testing it from below. You have the 200-day exponential, simple, just above it in the blue line, and then the red line there. I'll get to, well, let me do this now. Let me go to the charts and show you the ones I just got out to you today. So you have QQQ. I gave you the 60-minute chart, and I gave you three levels, any or all of which will provide objective shorting entries. My preference is this one here. We could certainly make it up there, but the more you go up from where you're at now, the higher you get up above those levels. And remember what I said last week. I said multiple times, this isn't a binary all or none thing where you take out, we took out that fell back below the downtrend line on SPY and the 200-day moving averages on QQQ and SPY. It doesn't mean that that's it. We're 100% going down. What I had said, and I continue to maintain, is the farther you get away from those levels, so we'll go back to SPY because it's pretty clear on that on this board right here. The farther you get away from these levels, and at this point now, especially if we do get rejected, even if we go up a little more, that's just going to increase the odds of another leg down in the bear market. And I believe I've shared with you my long-term targets. And likewise, the further you get up above these the 200-day, and there's the 200 exponential, then the more it's going to increase the odds that this was a whipsaw. In other words, will the real whipsaw please stand up? So we'll see if it was this breakout here. Is that going to be the whipsaw, big old bull trap, or will this be a whipsaw? I strongly favor this at this point in time. I just want to give you my convictions on it, and not only am I remaining short, I use that first level today to deploy some more dry powder. I think that's again an excellent shorting op. Here's SPY right here. You can see it also on a 60-minute chart, that is back testing the trend line from below right there. So that's it. I wanted to get the post out to you this morning and these charts that we could certainly push up a little more. Each and every one, depends on where you're at, what your thoughts are. You have a beautiful downtrend line right there on QQQ off the highs. You have again multiple price resistance levels, and they're all in close proximity. So this is my preferred scenario. And then anything much more than that, that's where I start scratching my head and say, hey, maybe something. There's actually a good level there, I should add. 303.27, really good level. It's support right there. We gapped down below it. We back tested there and failed. So let's just mark that up as an important color. We'll make it yellow so it stands out. All right, so that's it. But like I said, I favor, me personally being pretty aggressively short here on this bounce right now because of the bigger picture where we're at. Let me give you a few other charts. I gave you NQ this morning. I give you three R1 zone, which we're at right now, right in smack in the middle. We just hit the top of that first resistance zone, a pretty good one. Again, very objective level in my opinion to short, even despite the recent positive bullish divergences there. We had some here and they played out for what they usually do, but in a bear trend, in a bull trend, these bullish divergences usually play out for new highs. And then you can see here, last time we had a divergent low and a beautiful bullish falling wedge. We gamed it, we traded it, but it only went so far, and then we had the next leg down, and that's where we're at now. So now we start taking out again. I have certainly fine with it coming up. This is that comparable level I just colored up yellow right here on QQQ. So we'll make that R4 because that's certainly resistance level. Here, I'm going to just label it real quick. And you can also see the downtrend line right here. There it is on the 60-minute chart of NQ. Potential downtrend line. We didn't have that third validating tag yet, but so that's it. It's a bounce zone. It's relatively small. It's about not even 3%, about 2.8% to the upside. A little less than that, 2 3/4 up to R4, because by the time, if and when we get there, this line is going to be dragged like that. That's 2.5%, because it's going to take a little while to get there if we do. And so the way I look at it, that's a level where I think it's objective to continue to scale in, again, depending on where you're at with your positioning, and then stop scaling at that point and start looking to scale out if we continue to rise up above there. But I would not be adding. Something else might be going on. And remember, we'll have regained, if we get up there, we'll be back above the 200s in the trend line on SPY, the primary downtrend line. Okay, so those are your levels to watch. Let me show you a couple other things here. Let's talk about the VIX real quick. I do have some live charts. This is a delayed chart, but I've covered this many times recently. You have these periods of drawdowns in the VIX. The VIX usually comes to support and or breaks above a trend line. So we highlighted here at support recently, really good support, the primary uptrend line right there, and that's where the VIX exploded. Typically when the VIX begins to explode, first you break out. I've covered this many times. I have these circles. You break out, you tend to consolidate a little bit, and then the VIX starts to spike up. Once it breaks above that level of consolidation, that's usually where you have the big runs. There was the breakout above the consolidation after the downtrend line breakout. Again, something I've gone over many times. So that we're in that mode now. Now, the million-dollar question, is that it? Sometimes those spikes are only about that big. When I say only, it's a big trade, very profitable. The VIX went up about 70% in just a few days there, and that's in line. Some of these were a little bit bigger. Some of these spikes, since the bear market started, might have been a little bit smaller, but that's pretty much in line. But this one here, for example, from low to high was about 121%. So, and I wanted to show you that it's not always, once you start taking off, once it starts moving away from that consolidation zone. See, you had a big down day there, you had a big red candle there. So it's not always a straight up ride. Today we have a red candle right now. If we finish the day up in the markets, certainly a possibility. It's going to give us, print that red candle. If somehow we reverse today and have a sharp down, especially if we close the day red, that would be a get out of Dodge a get out of Dodge moment for the market, for longs. If somehow this rally, because it's pretty strong right now, the NQ NASDAQ futures are up about 1.8%, and that would be a heck of a fade. So let's see what happens. Like I say, resistance is resistance until unless taken out. If you take out those resistance levels they give you, then that opens the door, increases the odds you're going to go up to the next one. Doesn't guarantee it, but increases the odds certainly. But as of now, we're at resistance, as where I started the video and where I got those charts out to you this morning, right at R1. All right, one other thing I wanted to show you on the markets, and then I'm going to do a quick update on gold and silver. I just covered those shorts. I told you yesterday, shorted gold, silver, and treasury bonds after being long, and as hedges to my index shorts, and those hit my pullback targets, and I've reversed back into those as longs, all but treasury bonds. Let me show you this. Look at Apple. Oh, well, we're on the VIX right now. I want to show you the Apple is so big, probably has its own zip code, but it certainly has its own VIX. This is the VXAPL, the CBOE Apple VIX. So just like you have the VIX we were looking at, which is VIX, pretty much for the stock market there, you have a VIX for the Apple stock, that is. And what I've noticed here, you can see, we'll go back since the bear market started here, and more recently you have these downtrend lines, right here, downtrend line, downtrend line, downtrend line. Let me go to a board without a bunch of, well, I'm going to leave this one up because I already had it annotated. So here's the pretty much the upper bounds of the Apple VIX. And you can see I also have a trend line. You can see that the lows have been pretty much it's been making higher lows for a while, going back a few years. But what I wanted to highlight for you here is this. So Apple, as most of us know, is the leading stock. It's the largest by market cap, so it's the top component and has the biggest impact on both the NASDAQ 100 and S&P 500. So what I've noticed here, when I look at these downtrend lines, and even if I added one there and right there, you get these pretty steep downtrend lines. When they break, especially these last three, you tend to have a sharp move up in Apple, the Apple VIX volatility. This move up, we broke out, and so far, market's up, Apple's up today. This one's delayed, so keep that in mind. It's the market's open, so it's showing what's going on today. But let me do this for you. Let's overlay what Apple did. So we edit chart properties, and I add a comparison. I add Apple in white here, and now you can see. And again, I didn't have all these lines. I just started marking this up last night. There's the breakout, and look what Apple did. I'm going to try to measure it. Well, I'm just going to show you. It's the white line, so it's a line chart there. That was the drop in Apple following the breakout right here. Just when the VIX started moving up is about when Apple topped. We had a breakout right here, right there, and you can see Apple peaked. And these are all the major drops in the bear market in Apple. So we'll measure it down to that one. There was another breakout. You had another leg down in Apple. And right here, you've had another breakout of what I believe to be a pretty clean downtrend line. And so the only thing missing is Apple dropping. So either this pattern plays out or it doesn't. Sometimes just about the time I notice a clean pattern on something like this is about the time it stops working. But based on my analysis, based on where everything's at, I believe it will play out. I believe that the shock waves that have been sent through the market, the Fed's put a little, took their finger and plugged a little hole in a dam that is continuing to crack and just starting to crack. It started with crypto. I warned of shoes to drop in the financial system, and now we certainly have seen that. And what I believe is going to be happening soon is liquidation of big positions, just like we usually see in bear markets and big corrections. The leaders, as good as the fundamentals are, I know you're probably scratching your head saying, Randy, you're crazy. Apple's the strongest stock. Why would? And I'm not. It's really not. I'm not sharing this as a shorting or shorting opportunity, but you could based on that, because again, you can see these are the big drops. I took away the VIX, Apple VIX, but those were when those let's call it sell signals were triggering at Apple. So I do expect, and I maintain what I said yesterday, that up the last few days have seen the small caps and the S&P 500 outperformed to the downside or underperformed the big tech. But I think big tech's coming. I think the next hammer down is coming, and that will take the Apples and the Amazons and the Microsofts down. And from a technical perspective, a lot of those stocks, here, let me take off that comparison. Edit chart properties, take off Apple, and just go through a couple of the QQQ components. And give me 1 second to sort this list. I have a list here. There we go. And let's just look at the weekly chart. So there's Apple, still flirting with the 200 days, just above it. So this is one we need to see Apple, like the market, take out the recent lows, and I think that's going to be a bearish event, because recently it was trading below the 200-day moving averages. It's kind of cut between them. Apple, again, has been pretty much the strongest of the whole lot, the big tech companies. And you're not going to have that final leg down in the bear market, or the next big leg down that I'm talking that takes out the October lows, until this leader breaks. And I think that's what's coming based on what I just showed you, coupled with what I'm seeing in the markets. There's Microsoft. You can see I have a couple trend lines here. I'm on a weekly chart, by the way, is what I went to. That's my BOD, or benefit of the doubt, because that catches the highs right there. You've got a lot of reactions, comes right in on those reactions, and we tried to pop it there, and it was a failed breakout. You're also trading. You can see the red and the blue line, the 200-day simple and exponential moving averages. We're right on them right now. So we are at a make or break level. If the bulls can do this to the market, to Microsoft, to these big leaders, get them up and away from these bear market downtrend lines, it's clearly up and away. And again, this is what, this is why I say give it a little room. That's a intra-week breakout followed by a failure. You can see that long skinny part, that's a shadow up top, or they call it a wick, or the shadow on either side, the skinny part, but it's a wick on top, a tail on the bottom. So that wick went up intra-week and then only to close back down below the trend line. Second week, same thing, and you close, the red candle shows we closed also below the trend line. And there we are. So we're testing it from below. And again, I can go through a lot of the big names like this. Here's Alphabet. There's my, as you can see, my BOD, or benefit of the doubt trend line, includes those two false breakouts of the primary. There's my primary bear market downtrend line. It has more reactions, and we're below it. So based on this, there are a lot of things. Again, I could sit here and give you the bullish case too and show you that it's a long-term uptrend line. I do have quite a few market leaders still holding key long-term uptrend lines. So I continue to maintain we're at a very critical technical juncture. It will break either way, especially in stocks like this, because that's a triangle pattern. It has to break either way because you're at an apex. You've got nice resistance there at 105.55 and the downtrend line bullish for Alphabet, bearish if it breaks the trend line, and then that $85 support below. So as of now, I'm leaning that way because we are, again, below the majority of resistance levels that I'm looking at. And let's see, this week certainly holds the potential to change all of that. So how to determine when that happens? I think the early sign will be right here. Back to where I started the whole video and what I got out to you today. R1, R2, R3, and really that for lack of a better word, line in the sand resistance level. They're about 303.27 on QQQ. And when you go to SPY, remember you're already at, I'd probably look at the daily chart on SPY and show you, you're at the downtrend line. You're at the just below the 200 simple, 200 exponential, just above that. And, of course, we're still below this uptrend line off the lows by quite a bit, too. So, anyways. Oh, okay. Told you I'd show you the ones that I covered real quick. Okay, gold, like I said, I only wanted to hedge up and trade a quick pullback. This is my hourly chart on GC. So you had here, let me pull it in tighter. We had a very steep uptrend line, and that was it. I was only targeting the first pullback support level. And we could go down more. I have some additional levels. I'd be a buyer. I'd add to gold here. I didn't go back in too heavy, but I did cover the short right there at that 1901.50-ish level. And that's a possibility to come down near the 1875. I would be adding to gold if that happens. And then silver also, where's that? Silver, that was the hourly chart I shared with you yesterday. That was the support zone, my pullback target zone. We hit it right there. And you're also right on this uptrend line right here. So, like I said, they got ahead of themselves, the metals, and it was a good fade trade and hedged up. That was about a 2.7% drop in silver, and then Treasury bonds, same thing. What you're seeing is risk on, risk off, and today is risk on at this moment in time, and so therefore, let's see, up until now, that's why the metals dropped, and I'm trying to find ZB for you, and we'll wrap the video up. ZB, here we go. And that was it. So that was yesterday. I showed you, well, I'll show you that right now, but that's a nice pullback in treasuries to really good support. So if you hedged up by shorting treasuries and or the metals, not a bad time to take some profits right there. We could certainly go lower. Remember, one of the cases to short treasury bonds was if you look at TLT, you're right at this nice downtrend line right here. It's almost a horizontal line, slightly downward sloping, and the 200-day moving average. So that was where I highlighted yesterday. So either who, that they worked well, and so now I'm really, let's say, naked short on the indexes, because those were my what I call indirect hedges. A direct hedge, if you're short QQQ, then you can buy QQQ calls, or you could buy one of the ETFs. I don't like direct hedges. They do me no good. It's one to one. You're burning up buying power. I don't see a reason to directly, if you're short Apple and you buy Apple calls, you're spending money. Why not just close the position out? That's usually what I do. So therefore, I prefer indirect hedges. They don't always play out, but quite often they do, and sometimes they can even play out better if you let's say, for example, had the market drop today and gold and silver continued to drop, I would have profited on all those positions, and that sometimes happens as well. So the only reason I'll take those indirect hedges is if I think they're going to play out, and I'm just not so sure about my existing position, which, my main position I was trying to hedge, again, which are the indexes yesterday. Hopefully that makes sense. All right, so that's where we're at. I'm going to wrap the video up here and intently watch, and like I said, personally added to these shorts right here at R1, and we'll see where we close the day. Certainly do another update if we can power on through here. Won't be much of a change until and unless we take out that 303 level right there. That's where things start to get a little bit, let's say, blurry, if you will, on where the market's headed in the near term, in my opinion. All right, this has been Randy Finney with Right Side of the Chart. Have a great day.